Go. All
Okay,
right,
we're live.
we are. All right, welcome everyone. We are talking about um, rental property ownership for kind of the average Joe, for someone who's maybe not trying to go crazy, at least right now, of getting a huge portfolio and tons of different properties or massive properties, but just wondering about specifically kind of residential, small scale rentals. And so, what I'm going to do, Dad, is break it down into um, four different scenarios, and we can talk through each one. So,
Okay.
one of them will be if you own a house right now and you
Okay.
want to move and rent out your first house. So you own a house right now, you're going to either go buy a house or maybe theoretically you're going to go rent in another place and then you're going to rent out your house. Next scenario is where you own a house right now, you live in the house, and then you just want to buy a house that you're going to rent out. So you stay in your first house and you want to rent out the house you're buying.
Okay.
Third scenario is you don't own currently, you're renting right now, or maybe you're young, getting out of college or living with your parents, but any scenario you don't own right now, and you want to, you've heard that it's a great opportunity to buy a multiplex and rent out some of the other units. And then last scenario is, all right, you are maybe in a similar situation, but you don't want to go for the multiplex option. You just want to buy a house and rent out some of the rooms. So we're going to talk through kind of the financing, the lending side, what that looks like, how it's different in each scenario. Good?
Good.
Cool. All right. So let's look at the first scenario. Owning house. You're living in a house. You own it, and you want to move and rent out the first house that you've owned. So right off the bat, let's say you have a mortgage on this place.
Okay.
You have a conventional primary residence mortgage. Something you'll hear sometimes is that people are worried that you have to refinance and turn that into a rental loan of somehow, an investment loan on the first house if you're going to turn it into a rental. So is that allowed? Do you have to refinance?
No, not at all. I think maybe where people get that impression from is that, when you finance a primary residence on your deed of trust, you're signing a statement in various places in the loan application as well, but on your deed of trust, you're signing a statement that says it's my intention to occupy this property as a primary residence for at least a year. And that if you want to change that, you need the lender's permission. And so I think people maybe infer from that, and obviously you're overwhelmed by all the documentation and things that you get when you buy a house. You don't read everything, you don't really pay that close attention. But they think, oh, well, now this is no longer a rental, or I'm not even allowed to move out of this and turn it into a rental. Sometimes I've heard that. People think, well, I can't even do that. I'm not allowed to do that. And of course you can. And where you might kind of run into some issues is if it's been less than a year since you financed that property as a primary residence, then technically you should reach out and you should never go into a property with any sort of misrepresentation about your intentions for occupancy. But that doesn't mean your intentions are going to be 100% realized. You could fully intend to occupy the property for a full year, and then 9 months in, life changes. Whatever happens, property didn't work out, you get transferred in your job, you have a baby. I've seen them all, right? I've seen all of those happen where there are legitimate intentions to occupy as a primary, and that changes, and that's okay. And just notify your investor, your lender, that your intention has changed. And usually this will only come up when you go to finance a second property, because then you go to finance a new property and buy it, whether you're keeping that old property or not. Fannie and Freddie both have systems that are going to flag that and say, wait, this person financed a residence as a primary less than a year ago. Now they're doing it again with a different address. What's up with that? So you'll have to explain it. But no, you don't. What was the question?
Yeah, is it allowed? Do you have to refinance?
Do you have to
turn it
refinance?
into a?
So you absolutely don't, and it is good practice not to wait for them to reach out to you, just to notify there's a decent chance that you'd never hear from them, even if you never reached out to them. So let's just put that out there. There's a decent chance. But I would say just proactively, just reach out to them and say, hey, my intention changed. This is what you don't have to document things. Just say, hey, I am transferring, to a new property, and I'm going to retain this as an investment property. Just giving you a heads up. And there's really no reason for them to call it on that basis. There's no real basis for them to call that loan due, as a result of that. And you certainly are not required then to change your financing. Now let's go to the situation where it's been more than a year, which is going to be most people, right?
Mm-hmm.
Most people.
Because the original document only specifies what it does, which doesn't even necessarily prevent you buying new, but it only specifies what it does for the first 12 months.
Yeah, it only stipulates that you have to have this intent with regard to the first 12 months. So after the first 12 months, then you're completely at liberty to do whatever you want. So you can, 13 months in, you can, retain that property, go buy a new primary residence, and keep that one as an investment. You fulfilled that initial year commitment that you made, satisfying your intent. It was actually realized, and there's absolutely no reason you would have to even notify the lender at that point.
So then if you are, let's say, okay, you've got, just to put some flesh on it, you have the house that you're living in is worth $500,000. You have, let's say, 50% in equity there, so you have about $250,000 in equity there, and you're going to buy a house that's worth $700,000. How does financing that new property look? How does qualifying look? If you're planning on renting out the income or renting out the previous house, can you use some of that rental income? How does qualifying then look for the new property that you are buying, that you're moving into?
Yeah. So the best way for me to kind of differentiate this is to set it in contrast with, so in this scenario you're asking about, you're moving out of your primary, you're retaining that current primary as a rental property, you're buying a new primary. So when you're buying a new primary, you're going to have to qualify for the new home plus the old home. So in this case, you said it's worth $500,000. You have $250,000 of equity, so you have a $250,000 mortgage on this, say, and there's going to be a mortgage payment and real estate taxes, homeowners insurance, maybe homeowners association dues. All those housing costs are going to be part of your debt to income ratio qualifying for the new house. And so if you can't carry two houses at the same time,
the monthly payment,
right? And you can't qualify, because that means your debt to income ratio is going to be higher than if you're just qualifying with one new house and you sold the old house. One of the ways to deal with that is by using the rental value of the house that you're departing. Now, in order to do that, this is where it differs. If you were to say, look, I'm going to keep my current primary residence and I'm buying a new investment property. Well, when you buy a new investment property or rental property, then the appraiser goes out and says, here's a market rent analysis of what the rental value of this property that you're buying is. That's a part of the appraisal, typically. Typically, you have the regular appraisal that says this is what this house is worth. But then a part of that investment property or rental property appraisal also has a market rent analysis saying, and this is what the typical rent values are for a house like this in this market. And when you're buying an investment property, that appraiser's report is all you need for qualifying income, to use that rental value as qualifying income. You don't need a real lease. You don't need an actual tenant. You could be buying from people who owned it as their primary residence. And so there's no renters in that property. And all you have is hypothetical rental value. But as long as the appraiser gives you that report, then they will use that rental income to offset that mortgage payment. But when you're buying a new primary, and then you're planning to convert your current primary into rental, then the only way that you can get rental value for that property for conventional, I think FHA and VA as well, is to actually have a renter. You need to have a signed rental agreement and typically a security deposit in hand at closing. And then underwriters will then use that to offset the housing cost of that departing residence.
So the difference is you're buying one scenario where all you need is the appraisal saying this is.
You don't need a tenant.
Right, you don't need someone who's signed a lease agreement and
Right.
giving you security. Is when you are buying a property that you are going to rent out.
That's right.
That you are buying a rental,
If
and
you're
maybe
buying
you're
a
going to live in
rental.
it. Maybe it's a multiplex, whatever. But
Well, that's a different. Yeah, we'll talk about that separately.
so the property I see the property that you're buying is totally a rental.
Yeah.
Okay.
So if you're buying totally rental,
You're not going to live in it.
Right.
Total rental. All you need is the appraisers.
That's right.
Whereas the scenario we're talking about, you would need, which is where you're currently living in your house. You're going to go buy a new place, move into that place, but you're going to rent out the place you're currently living in.
Right.
Then
Now-
you would need.
Now you don't have a renter in there because you're living there typically. Let's say it's not a multiplex or not. You don't have an ADU or somebody renting your room. You're just moving out of your house. You have no history of rental. Sorry, I got my Chamber of Commerce president wondering if we're going to be presenting on Thursday. We are, if you want to be there. Anyway, so yeah, but if you are departing, leaving your primary behind, you don't have a renter in there. And you can't use just a market rent analysis. Even if you get an appraiser to do a market rent analysis, generally that's not going to suffice. You need an actual contract with a live, real person that's going to rent that property and a security deposit. And then as long as you have those two things, then typically that will be sufficient.
Perfect. Okay, so that's helpful as far as that first scenario. Second scenario, let's say and we've touched on this.
Touched on this, but
you own a house and then you're going to stay in that house, but you just I want to start investing. I want to get some rental income, but I'm not moving. I'm not renting out the place I'm doing. I'm just going to go buy a house. And rent it out. How is the loan different specifically? Let's start with down payment. What are the required, or what options are out there as far as how much down payment you would need for a purely rental?
Yeah, usually
property.
on rental down payments, you're going to want to get to 25% down, typically because the pricing hits for less than 25% down are actually fairly substantial. And so you're going to be paying much worse pricing. Now, I'm going to have to look this up. Is this fair to do?
Yeah, it's fair. What are you looking at?
The LTV limits on rental value, because I so rarely have people go less than 25% down because the prices are so bad.
So generally, you're thinking you can go below 25% down for a down payment, but the interest rate and all the other components of your pricing are much higher if you do that.
Yeah, your pricing is so much higher. Let me just double check this right now. So let's see, rental investment property. Yeah, it looks like they'll go to 15% down minimum is what you're going to see. If it's a multiplex, typically it's going to be 25% down. If it's a 2-unit, for example, then your minimum is going to be 25% down. But if it's a single family, then typically you have to put a minimum of 15% down. But again, your pricing is going to be so much different. That doesn't mean you shouldn't ever do it, right? That's there are situations where that's just what it takes, and there's value in the property, and it. Your numbers, and you can do that. But yeah, usually you have to put at least 15% down, and you'll get a significant price improvement if you get to 25% down on a rental property. So that's that's kind of what you want to do there.
And then as far as let's say you do get to 25%. How do rates generally compare versus a primary residence? If you're going to move into a primary residence and let's say where we're at right now is somewhere around the sevens, high sixes. Generally speaking, for primary residence, conventional conforming, all that, does it jump massively in terms of interest rate for if you're just buying a rental, or how does it generally compare?
Well, let me just see, because it changes, it changes quite a bit. So let's say, I mean, from different time points in the marketplace. So let's just answer that today. Let's say you put 25% down and it's a purchase of a primary versus a,
So you're saying that sometimes in the market, a primary will be pretty similar to,
no,
or not pretty
no.
similar, but more similar to a rental
Yeah,
than at other times it might be drastically different.
yeah, and let's just, let's compare, let's compare a first-time home buyer, primary residence purchase to, let's say you put 25% down, and we're talking about a primary residence purchase, good credit. And right now, let's look at what the no points rate would be. And I like to do this slide because it really does. You can generalize about things, but then, different price points, different days in the market could be significantly different. And so today, let's see, we got so today for a primary, you're going to be at roughly, let's say 7.2. And that, did I say first time home buyer? Oh, let's do, let me get a better quote on that. Hold on. I just had to change it to the first time home buyer. I meant to do that the first time. Thanks for bearing with us, all you loyal fans out there. Yeah, so you can go roughly right now about 6.875. If you're a first time home buyer, primary residence with good credit, 25% down, 6.875. Now let's change that to a non-owner occupied investment property. And now let's get that quote. So we're going to go from 6.875. And I imagine this is going to be a fairly significant difference. Oh yeah, this is like, whoa, like eye-popping. 8.3. Now if I take that down, same pricing, I'm going to be at about 8%. I can be about 8%. So that's about, that's a point and 1/8 difference. Now that's between a first-time home buyer who gets some pricing breaks, along that versus for a primary residence versus a non. It doesn't matter if you're first time or not. You're buying an investment property.
Yeah, I mean, I guess it wouldn't be a first time because if it's the scenario where you own a house.
Yeah, but either way,
Yeah.
that pricing doesn't really change on the investment side. So so it's a rather substantial difference. Now I think we saw what I accidentally priced out the non-first time home buyer pricing there to begin with was more like 7.25. So you're talking about 3/4 of a point difference, maybe.
Yeah.
3/4. So it's fairly significant.
So right now it's noticeable for sure, and that could be depending on your loan amount, that could be thousands of dollars.
Yeah.
But it's not like we've seen manufactured homes without land that are in 10 to 12% range right now or the last several months. So it's not like at least right now it's not 5 to 10% difference.
Yeah, no, I mean, historically, I think there was like a 0.5 point historically between primary and investment. And it's just that the pricing mechanisms have gotten so much more complicated with all of the federal programs of trying to incentivize first-time home buying and make things cheaper, all because rates are super high and it's hard to afford to buy a home, right? And so they're trying to do what they can to kind of make that more affordable. And as a result, the rate sheet's gotten more complicated, and so there's just a lot more factors that go into figuring out this loan versus that loan. But I would say historically it's been about a 0.5 point between investment property and owner occupied. And right now that, if you're a first time home buyer, that could go as high as 1.25 difference in rate, not even difference in fee. So
I wanted to ask about, for that same scenario, you own a house, you're buying a new house as a rental. In terms of the just finding the funds for the down payment, this is kind of not specific to this scenario. It's more of just, I guess, a financing question in general. If you wanted to take out a HELOC or a cash out refi on your current house that you have some equity in to get the funds for your down payment on the rental, what would that be an option for a HELOC? Can you use the cash for that? Cash out refi? What would that be something to consider? Is that an option?
So first of all, the HELOC, yeah, absolutely. That I think that's one of the something you should consider if especially in terms of if you're looking at saying I have 15% down and can't quite get that extra 10% down, but I want to buy investment property. I would seriously consider tapping into a HELOC on my current primary residence to augment your down payment funds available for the purchase. Because basically then what you're saying is, okay, what's the cost of this home equity line of credit? And you should be able to get HELOCs for free. Just, in most markets, you'd be able to get it for free. And then you're just, obviously you have some portion of money that's out there on a variable rate home equity line of credit, but it's generally going to save you a bunch of money on what the whole mortgage is on the investment side purchase, right? So if you're buying a $500,000 investment property and you're going to borrow, $400,000 on that, if that rate or your fees change by several $1,000s and your rate changes on that investment property because you can put 25% down instead of 15,000, well, that's an additional 10% down on a $500,000 purchase. That means you got to borrow an extra 50,000 on that HELOC. Well, even if that HELOC's at 9% interest right now, because the prime rate's at 8.5 or whatever, still the cost of that HELOC is probably on $50,000 is going to be significantly less than the added rate on the full $400,000 if you put less than 25% down. So I would definitely consider that. Now, doing a full cash out refinance on your primary, maybe, but that's a more complicated analysis because then you're looking at, well, what's my current mortgage? If I'm sitting on a 3% mortgage and I owe $300,000 on my $1 million house and it's at 3%, do I really want to cash out? Certainly, to get 50,000 more to put down payment on that, that's just not ever going to really pencil out, right? To borrow 350 at 6%, 7%, whatever rates are now versus your 3.5. But if you know nothing, on it, then maybe you look at that and say, doing a cash out refinance on my primary and then paying cash for that investment property gets me a better rate. So there's certainly questions worth asking, and you should just always do the math. And not all of it is strictly financial. Some people just have different emotional connections to their personal residence where they think, no, I own this free and clear, and if I refinance on this to buy investment property and then I run into trouble, then my personal residence could get foreclosed on. So even though it saves me money, I don't want to do that. And that's fine. That's a personal decision based upon your own how you feel about doing that, and you should of course always take that into consideration. But for some people, it's just the math. It's just like I own 2 properties, and if I get into trouble, then collateral is the property, and something's going to have to give, and we'll sort that out. But you would potentially do a cash out refinance on your primary residence because it might be cheaper than financing the investment property, and so it's just a question of doing the math and seeing how much cost that is and seeing how that resonates with you based upon your other feelings about that.
Yeah. So let's move to multiplex, duplex or quadplex or whatever. And this is again going to probably overlap a little bit with the first scenario, where you're considering buying it and living in one of the units and renting out the others. Let's just, for the sake of the scenario, let's say you don't own a house currently. You live you're renting or whatever. Of course, again, if you are living in a house, it's still going to be similar. Even if you're living in a house right now and then you're going to move in and buy a multiplex. But if you're going to move in and you're going to buy a multiplex and you're going to live in one of the units and rent out the others, let's start with down payment. What are the requirements for down payment on a multiplex if you're living in it?
That recently, let's see, multiplex, that recently went to 5% down. Okay, you can actually, that used to be 15% down if you were to buy a multiplex and live in it as a primary residence, and whether you're gonna rent out part of it or not, that's typically what you're gonna do with the extra units. You're not gonna sit on them,
For conventional.
but for conventional lending, it was generally 15% down was required. That changed probably within the last 6 months or so ago. And again, that was with kind of a nod toward trying to expand all the different ways that that young buyers could qualify, or first-time home buyers could qualify, because qualifying based upon just your income alone, buying a new house wasn't always working out for everybody. This way, you can qualify based upon your income, but also the investment property, value, the rental value of those other units, whether it's 1 unit or 3 unit or 4 unit property. There's going to be either 1 or 2 or 3 extra units that are available to rent, and you can qualify based upon the imputed rental income, the estimated rental income that the appraiser will do. So this will be similar to buying a rental property outright, where you're buying a property and the appraiser is going to comment on or evaluate and report on the estimated rental value of those other units, and that helps you qualify.
Could you do that for a building with 10 units? Is there a limit on the units for that down payment?
Yeah, for residential Fannie Freddie financing, you're limited to 4 units. It's 1 to 4, 1 to 4 family.
Which is where you can get that 5% down.
Yeah. Well,
better interest rates.
You might be able to get,
Sure.
I'm not expert at commercial financing. We have some access to that. I haven't done a ton of that. So I'm not here to say whether you can or can't get that. I would say it probably will require more down typically. But once you get over 4 units, now you're no longer in what's considered residential financing. Now it's commercial financing. So you just have to go somewhere other than Fannie or Freddie for that money.
Okay. And then would this be similar in terms of qualifying? Would it be similar then, let's say it's a duplex. Would it be similar then to renting out the home you're moving from, like we talked about earlier, or do you just add the rental income from the other unit? What's required in order to count that income? How does qualifying that rental income look like?
Yeah, that qualifying rental income it's not, you don't have to have it actually rented. You don't need a lease. It's just factored into your qualifying calculator debt to income ratio calculations as additional income, because it is a property that you're buying, and it's got a rental component to it.
What numbers used if you don't have a lease? Is it just based on the appraisal again?
Based upon the appraiser. Yeah, the appraiser will do a market rent analysis and tell you, renting a duplex in your market at that address is going to net you $1,300 a month, or whatever that number is.
So, like, practically speaking, in terms of like picturing why you might do this, how it might look, do you think it's possible sometimes maybe someone's looking in a market where, man, I just can't qualify, or I'm just not comfortable with the monthly payment of a single family house, just taking it on ourselves. But maybe there's a scenario where there's a duplex where obviously it's going to be more expensive than a comparable single family, but then you can add the rental income. What scenarios have you run into with clients that are considering something like this? Is it just I want to get into real estate, get some of that rental income, and make some money by working on the house, or what scenarios have clients kind of?
Yeah, I'd say it's kind of all of the above. I have some clients that are it's a multi-generational situation where the different generations want to move in together. They want to own property together. So you have that situation where you have, let's say you have an aging parent, and you want to be close to them, to be available to them, kind of when they're going to need you more. but you don't want to live together. You don't want to necessarily live in the same house. So I've seen, people searching for that. I've seen young kids who are wanting to be first-time home buyers and want to build an investment rental portfolio. Want to start young, build a rental portfolio. And it's tough to come up with 25% down, when you're young and just starting out. And so they think, well, I'll just buy, I'm going to buy a home anyway to live in. I'll buy a multiplex, I'll buy a duplex, let's say, and I'll have somebody rent on the other side. And then eventually when, as I progress along, financially and vocationally, then I'll look to buy that next home. And maybe it's another one, or maybe it's a single family, and I just convert this to a fully rented, multiplex. Mm-hmm. So I've seen it in a variety of ways, and and then people just buying multiplexes outright. That's their thing. They like the efficiency of buying a multiplex, right? You can have people count the number of doors you have. When you're a rental investor, that's kind of one of their metrics: is how many doors do you own? And if you have 2 doors, but it's 2 separate houses in 2 different parts of the country or 2 different parts of the city, that's a different management prospect than if you have one house that's a duplex. It's got 1 insurance, 1 property tax, 1 address, to go manage, but you got 2 different renters, and you got dual streams of rental income. So yeah.
One last scenario, and I think this one should be pretty quick. You're okay. No, I can't quite do that, or we're looking at just a single family residence. Young couple looking at a single family residence, or single guy, or whatever the scenario is, and we want to rent out a couple of the rooms. We want to get rental income from just renting out some rooms, bring in some roommates. Does that change qualifying at all? If someone hears the multiplex thing and says, oh, you can use that rental income to increase what you can qualify for. I like this house, but we can't quite qualify for it. And we were going to rent out some of the rooms anyways. How does that impact things?
Yeah, most of the time, that's what's technically called border income. When you have borders and you're charging them rent, they're not. So you typically can't use rental income or implied rental income, or even documented the rental value of something if the house isn't technically have more than 1 unit, 1 more living unit. So if you have an ADU, even that can be tricky sometimes, using rental income associated with an ADU. Now those guidelines are changing and maybe expanding a little bit. But generally speaking, if you have border income, there are some programs that allow for border income, but typically you have to have a history of having collected income from borders, and you have to have reported it on your tax returns. And so you start to kind of narrow in the number of people who would actually benefit from that. There's just not a whole lot out there, but it's possible.
So you might be able to, reap that income. Might be a way to cushion your payment, but it's not going to be something that will change what you can
qualify. Yeah.
Okay, cool, helpful. Great. Well, thanks, Dad. I think that's a helpful walkthrough of just what those options are out there. I think it's always it's an exciting opportunity, just because there are ways, if you're a single guy buying a house and you have the opportunity, you don't really have any reason to just want a single family. Maybe you have the opportunity to buy a duplex, and I think that's obviously not the only scenario, but if you're in the right scenario where it just makes a lot of sense, like you said, it seems like a really efficient way to get a return on your investment.
Yeah, definitely.
Awesome. Well, thanks, Dad, and thanks for watching.
Yeah, you bet. End stream.
Yes, sir.
See you, stream.